Okay, so now as we know that what is basic earning per share, we have to calculate VANs. For this purpose, we need to also figure out how to make the VANs table. I have told you the format, but now there are set of rules as we discussed that there are set of rules. So I'm talking about rules. Rules. Okay. So now first rule is always start with the beginning of year irrespective of entity incorporation. So I will tell you what is mean by that. It means that if we have accounting year, let's say from January to December or maybe from April to March, in such a case maybe your company is being incorporated or started its business or maybe infused their capital first time by raising the equity shares, maybe the month of June. So if you are having a financial year from April to March, then it means you have started your business after 3 months of your financial year end of 31st March of last year. So in such a case, we have to start our VANs table from 1st of April. So in such a case, if we have accounting year from Jan to December, if we are opening in the month of March, then we have to start from the month of Jan rather than March. So irrespective of fact in which month your entity is being incorporated, we should disregard this concept, this thing, and we have to always start with the beginning of the year. Okay, so in our date column that I just described in my format, in the date column it would be always the first date of the accounting period from which you will be considering how much outstanding equity stocks you have. Okay, so we will discuss in an example later on, so just hold on with me. Okay, thereafter now we have second point that talks about any actual change in number of share should be considered in should be considered in VANs table. Should be considering, apologies for my writing and this thing that is happening right now on my screen, but it's kind of something I've started and I'm trying to do my best in here, so hang on with me. VANs. Okay, so what does it mean by actual change? Okay, so actual change means there should not be any kind of potential change. Let's say you have a convertible debts in your books of accounts, so if they are going to be converted after a 1 year, then in such case you are not supposed to consider those in VANs table. though we will be considering in the diluted earning per share, but not for the basic earning purpose share. Okay, so now we talk about the third point. This is how we will capture this in Vance table. How we'll capture this in Vance table is, first point, SLE, separate line item. When your numerator is reactive, for example like fresh issue. Okay, so this was the first, this is the second one, that is AO, adjustment to opening balance. When we do this, when numerator is not reactive, that is split of shares and that is bonus share. If you know that in the bonus share there is nothing going to be changed in the capital structure. I mean, you are simply just setting off your reserve and surplus with the capital, right? So there is no any kind of free cash flow is coming into the business. That's why its numerator is not going to be reactive. That's why it is always adjusted in the opening balance. Why we adjust in the opening balance? So that once we adjust the opening balance, we consider it like due to which we have to restate our previous financial statement. We have to restate our previous year earning per share, because it's an adjustment opening balance. That means it's a kind of adjustment on our closing balance. Okay, so now we have discussed that rules of preparing Vance table. Now let's discuss one more thing, what I call equivalent number of shares, which is very much important here. So what happens in sometimes, like let's say you have a share which face value is 10 rupees, but 10 rupees face value, but 10 rupees face value, but paid up to 5 only. In such a case, we need to calculate equivalent number of shares. Okay, so let's say we had 10,000 partly paid up. So when we convert it into equivalent number of shares, then it is 5,000 shares. You got my point? So in Vance table we will be placing the 5,000 rather than 10,000 shares. That is equivalent number of shares. Okay, so now let's discuss one of the important point, that is difference. There's a one difference in here in in IAS 33 and AS 20, that is extraordinary income or loss. So in accounting standard 20, there is a reporting of EPS before and after extraordinary income or loss, but in IAS 33 or Ind AS 23, there is no such concept called external before and after extraordinary income or loss. Since the concept is very much simple, any business is carried out in the environment, there could be a foreseeable losses and foreseeable income which entity do not predict. So it's a very much nature of any business that is operating in the global economy of the world, right? So the IAS 33 and the Ind AS 23, which are aligned with each other, put the simple thing, there is no such concept of extra income or loss. So you will be simply having a normal basic EPS or diluted EPS on the face of financial, but not any kind of before or after extraordinary income or loss. Now let's discuss one more point, that as I told you that whenever the adjustment is happening in the opening balance, you see what I'm trying to say here, whenever there is sorry, whenever there is whenever there is adjustment in opening balance then we have to restate the previous year EPS to okay.